You're such an asshole!
Hey everybody, old, unshaven, unkempt Clary. One of those days where I woke up, had too much work to do. I haven't even showered yet today. I know I'm gross. Icky, gross video on economics here. Anyway, a young man writes, and he made me do my work. I had a really economist today. Hello, Mr. Clary. I'd like to ask how much it would cost for you to do a video on currency pegging and the benefits/disadvantages of a country pegging its local currency to the dollar, euro, etc., as well as how countries strengthen/weaken their currency. I'm asking because I lived in Russia for several years where the government used to support the ruble but let it free float, and as a result, the currency essentially collapsed. Now I live in the United Arab Emirates where the currency is pegged to the dollar. I'm planning to save as much money as possible and have developed a certain curiosity about this. Then we had a couple more questions. I'm like, okay, a little bit more. Let me know what you want to know. Where'd it go? Oh, and please briefly say something about U.S. policy towards manipulating the dollar. Russia and the United Arab Emirates have central banks, but I don't know if America officially has one. Yeah, we do. It's called the Federal Reserve, and it ain't your fucking friend. We have the central bank. If there was a central bank, it's the Federal Reserve. I mean, the Bank of England is their central bank. Bank of Japan is their central bank. They're all central banks, what is the European, what's it, EU bank? They give it a title, but it's still the central bank. Whatever is in charge of your currency is the central bank. So, all right, let's do this. I took notes, and the reason I'm going to take notes and go into a more structured format is because I'm just going to explain to you central banking and inflation and currency, which will then help you understand. I'll give you the construct or the model by which you can understand the hows, if, whys, whens, or buts of currency and currency manipulation. And on top of it, you'll find out there really isn't such a thing as a truly free-floating currency, nor is it really necessarily a thing as a perfectly pegged currency. So let's talk about this. A free float, what's that? All right, free float is exactly what it is. It's the free market. You allow the international currency markets to determine the value of one currency against others. They all trade against it and one another, and it's anybody's business. You go ahead, we're not going to intervene. Now, in a perfectly free world, a government would do one of two things with its monetary policy in terms of how much money it's going to supply to the economy. It would either print off a fixed amount of money saying, this is it. Here's, the United States government comes out and says, here's $2 trillion, all right? That should suffice for the rest of the foreseeable future to handle an economy that produces about 16 trillion of goods per year. If our economy goes gangbusters and all of a sudden, each divisible unit, like a penny, becomes indivisible, like a penny has such purchasing power because there's not enough supply of money, we'll revisit it. But right now, $2 trillion, that's it, fixed supply of money, don't care what happens to the economy. And what would drive the value of the dollar, or whatever currency that is the economic productive capacity, the economic production of that country. Because you can only buy goods in the United States with US dollars, just as you can only buy goods in Japan with Japanese yen. So it is very specific. That currency is specific to that country's economic productivity. Because I can't take Mexican pesos and go to Japan and try and buy stuff. They say, get that crap out of here. We trade in yen. That's the only thing that has value there. So the currency is very specific to the underlying economic production of the country. And what would typically happen is, as economies grow, which they tend to do over the long time, we tend to grow, the value of that currency, in this case the dollar, would go up in value. The purchasing power would go up in value. In other words, we would have deflation. Over time, the currency would deflate, the currency would become more and more valuable, purchasing more and more goods because there's a fixed amount. There's only $2 trillion. Hey, we produced 16 trillion this year. Next year we produce 20 trillion. Well, that's a 25% increase in production because it's that same 2 trillion that has to buy the 20 trillion of goods and services that was produced. Right? So that's one way to do a perfect floating exchange rate. Government doesn't do anything. The other thing the government could do is set a 0% inflation policy. We right now have a 1 to 2% because of reasons I'm not going to delve into. But what a 0% inflation policy is to have price stability. There's arguments that deflation or changes in prices up or down in terms of inflation or deflation is bad. So what this one aims for is, okay, we have $2 trillion in dollars in currency. The economy grows by 3%. We increase the money supply by 3%. So that way the money supply increases in tandem 4% with economic growth. And then you would have 0% inflation. Right? So that would also result in a relatively stable currency. Now that works if you're a stable economy, mature economy growing, United States, Japan. You could even say China, Britain. But let's say you're a second or third world country, just a new country, or you just came out of a war or something like that. And everybody doesn't know, you don't have the economic production. You don't have the trust yet of the international community as to whether or not the Venezuelan Bolivar or whatever, some shit third world country, whatever. We don't know who you are. Who are you? Why does your piece of paper have value? Because here in the United States, this dollar gets us shit. All right. There, I don't know what this dude who I've never seen. He's got the funny mustache. I don't know who he is. I don't know what this piece of paper is. And this weird looking currency over in Southeast Asia. I don't know. Does that get me rice? What does that get me? Who are you? So it's an issue of trust and economic production. So what a lot of economies do, as United Arab Emirates did, is they say, okay, we're a relatively small player. If I recall my history correctly about the United Arab Emirates, like, didn't their prince, like, he was a big revolutionary type, not revolutionary, but he modernized the economy. So what people would do is say, okay, we want to get on board with the international community, we want to modernize our economy, we want it to be taken seriously. We need stability. We need our currency not to be affected by speculators, because people could, a small little country, all it takes is one big multi-billion-dollar bank to fuck up your currency. So they say, we're going to peg our currency to a currency, an international currency, that is much more stable. The dollar, the yen, the won, the whatever it is. Pick a large, stable, or silver, or something. We're going to peg it to this currency right here. And what that does is it provides stability in terms of your prices, both in terms of imports and exports, as well as stability on the international, and your debts. Your debts they're set at this fixed level, and the currency you're pegged to might go up or down a little bit, but not as much as pegging it to the Mexican peso or what have you. So what this does, this stability allows for your economy to function much better, at least in the beginning. So prices are going to be relatively stable. You can make contracts. This attracts businesses. Businesses say, hey, it's denominated basically in dollars because it's pegged to the U.S. currency. So now I can invest in this plant. Or I can make long-term investments in this shipping yard, or I will buy a house here. So that helps attract investment. It also helps attract savings. So you have foreign investors coming in and say, okay, that's a stable currency. It's tied to the dollar. So I will invest my money. So you have foreign investment coming in. You also have domestic investment coming in the form of savings. People say, this currency is not some frou-frou Brazilian currency freshly shat out of the ass by the communist cunt they just kicked out. Okay? No, this is tied to the dollar. So now I will make my deposit into the bank. I know it's not going to be inflated away by some kind of currency crisis or whatever. And so now the banks have money. You have a functional banking system. And the banks can lend money to other investors and entrepreneurs and businesses. So people want to buy houses. So now your housing economy takes off, or at least it does well. And they can lend to investors and businesses. Okay, businesses want to borrow money to start Bob's Pizza Shack over in Shitsville, second world country, whatever. And so that allows you have now the savings and the capital is built up that we can go ahead. You have a domestic investment as well. So this then leads to economic growth, employment. You're starting to make your coconuts, whatever the fuck it is in the second world country you want to make. Giving your currency that, even though it's tied to the U.S. dollar, it gives it actual value. Okay, so it's kind of a you in the ideal world, I guess. And I haven't done an economic history study of it. In the ideal world, you would start off pegging to a stable country's currency, but then after you had a stable economy, say like Hong Kong or Singapore, you'd say, okay, we're getting off this currency. We have an infrastructure laid out. We have stability, we have law, we have a good, hardworking population. We're not Brazil, we're not Argentina. We're just basically not all of South and Central America. We're Singapore, we got our crap together. Let's go ahead and we're going to have our own currency. Singapore has its own currency. But anyway, so that's the value of the reason that you would have a pegged currency. Now, the problem with the pegged currency is, what if the currency you peg to does this? Now, the whole point you attach yourself to a steady Eddie currency was so it wouldn't do this, but sometimes it does. Sometimes, the United States, we had our Great Recession. With Brexit, the euro, the pound went down somewhat, not a lot, but it went down significantly against the euro and other currencies. So that's the one drawback of having a pegged currency, is you've tethered yourself to that boat, and if that boat starts sinking, you either got to cut the cord and float on your own and hope you're not battered by international speculators or other much larger international economic forces on your small little country. If you cut that, or you hold on and you go down with that ship. So there's that there. Now, that's the perfect world that I just explained to you. That assumes people are rational, they're not corrupt, they're not bankrupt morally, and they're not going to basically complicate matters and cheat. And that's basically what all of the world does and all the central banks does. So there are forms of complications. For example, I'm going to go through all the different types of complications that are common, you'll see, in currency manipulation and monetary policy and central banking. But for example, I lost, where did I go? Complicating matters. Dang it, I had a really good idea. You're pegging it. I even got the notes right here, but I had another. Hang on, let me get that going there. Just bear with me. Free float. Oh, okay, here we go. For example, let's say you claim your currency is free floating. Okay? Well, you can claim that like Russia does and like the United States does, but you could still have interventionist policies, you see, by the central bank. The central bank controls the money supply. It also controls this thing called interest rates, and it also controls what's called Federal Open Market Operations, FOMO here in the United States. I mean, I call it other ways, but they can buy and sell U.S. Treasuries, which increases or decreases the amount of money in circulation in the economy. We're not going to really worry about that. The whole point, though, is that I don't care if they call it floating exchange or free exchange. If you're constantly manipulating it by increasing the money supply, lowering the reserve requirement ratio, increasing interest rates, which is what Russia did a year or 2 years ago, maybe 2 years ago, and that's when your ruble tanked against the U.S. dollar. It's not really free floating now, is it? If the United States comes in and says, we're just going to print off a ton of money, well, how is that free? Oh, but it's free floating. It's free floating. Well, how is that? I mean, you would print it off once, be done, or you'd have a fixed policy. The economy increased by 2%, we'll print off 2% more. The economy shrank by 3%, we're going to contract the money supply by 3% more. All right? But if they go beyond that, and pretty much every central bank does, and you can read any modern-day economics textbook, they don't only talk about fiscal policy, like what can the government do in terms of taxation and spending. They cannot put their lips around John Maynard Keynes' dick fast enough to say, what can we do with monetary policy? And say, okay, well, we can increase the money supply, that'll increase economic production. All right? And we'll lower the interest rate, and that'll increase economic production. Which is another debate. But I just want to point out, right now, it's perfectly acceptable, and it's universal that central banks manipulate their money. And they do it, quote, to help the economy grow or to stave off a recession. But in reality, all you do is really cause inflation if you print off more money. And you basically, you don't have a free floating exchange rate. So everyone says they have a free floating exchange rate. You can see it going like this. But not even behind closed doors, quite open out in public. You say, well, the Federal Reserve decided they're going to do quantitative easing 5 this time. We're going to buy this many government bonds and stuff like that. That all goes into the market and causes prices to go like this. But it's no longer purely economic production that determines the relative worth of currencies against one another. It is now how much supply of money governments are printing off. So in the real world, there really isn't, I don't know, a place where there's a free-floating exchange rate. I really don't, because central banks are always manipulating. What else? Even like pegged, like some of them will have it sort of pegged. Look at China. That's a very interesting case. Well, we were fixed at this rate. Now we get a band. There's like a band, and then there's a drawing peg, and that's fuck it, free floated anyway, because it's going to happen in the real world. But this is another example of complicating things. Let's say you have a pegged exchange rate. It's pegged right here. Well, what you would do is, as long as I don't want to get too economic key on you, is if you have a pegged exchange rate, that means it's tied to the value of, let's say, the dollar. And if the U.S. economy grows by 3%, that means this currency must, in the real world, increase by 3%, because we have the same fixed amount of dollars. Our economy grew by 3%, so that's 3% more purchasing power. Well, your economy better produce 3% more, because if you're pegged to the U.S. dollar and your currency goes up by 3%, people in your country are going to say, wait a minute, our currency buys 3% more? You say, yeah, because it's pegged to the dollar. It's like, but we didn't produce 3% more. And the only way we can do that is if we go to the United States, because that's where the real economic production occurred. So if we had dollars, so you have an incentive. I'll exchange my oogity-boogity currency for U.S. dollars, and then I'll buy stuff in the United States. Well, people in the United States say, wait, we don't want your oogity-boogity money. We increased production by 3%. You went down by 5%. Screw you. There's an 8% difference in our purchasing power. Take your oogity-boogity money and go fuck yourself. And you can say, well, I'll fix exchange rate. Well, then if you do that, if you cheat, you have a black market form. Now, natural fluctuations in economic growth rates, as long as the economic growth of the pegged economy to the peg-or, the peggy, or the peg-or, as long as your economies are growing at roughly the same pace, you're not going to have too much stress put on that fixed exchange rate. But if you're not keeping up economic growth-wise, or, in the case of Venezuela and pretty much every leftist socialist shithole, you decide to print off more money because you're a fucking tard and you don't know that printing off money doesn't result in economic growth, then a black market economy forms for the real purchasing power. So you see this is a perfect example, is Venezuela, where they just print off more boliviars or whatever, or Zimbabwe is another perfect example. Usually they use it to pay their employees, the government, they use it to pay the military, they use it to pay their debts. But because they're just printing off more money and there's no actual value to it, they can, and they've done it. They've done fixed price controls. Venezuela, it's one peso, Boliviar or whatever the worthless currency is. It's, I don't care what their exchange rate. They say there's a fixed rate between our currency and the U.S. dollar. Yeah, no one's going to actually give up their valuable dollars for your shitty, worthless Venezuelan pesos, whatever the fuck it is. So real, and you can't escape the real world. So this is what ends up happening is the Venezuelan government insists on this exchange rate. Nobody exchanges the currency. You know what happens when nobody exchanges the currency? Nobody invests in your country. And not only that, nobody sends imports or provides goods and services. This is why, in part, it also happens on a domestic level. This is why, in part, you see empty shelves and they're running out of toilet paper. Because they've made it, a business cannot run unless it makes a profit. And if you fixed your exchange rates at places that are just not profitable, then you're not going to get a supply. Sony's not supplying TVs to Venezuela because fuck you. The United States is not supplying engineers to Venezuela for their oil fields because fuck you. You're not paying us with these shitty, worthless pieces of funny money. So that cheating occurs, but it's still in the black market, the underground economy. I don't know what the real exchange rate is, maybe $6. Well, let's look it up. We got the time. We'll do a little bit of economics. Venezuelan, I think it's the Boliviar versus US dollar. Yeah, the Boliviar. Now, of course, they say it's, 1 to 0.1. Where's the chart? I want to see the chart. View chart. Read important analysis. Yeah, if you look at this chart, it's very fixed. It's very beauty. And they're trading in 1 or 2 pennies. So it's a fixed rate. Yeah, and you could see it. Let's show you here. You see this fixed? That doesn't look like a normal chart, right? So that's not normal. That's the government fixing it. So let's move this back there, not to give you a seizure. Anyway, this is all cute. That's what President Maduro thinks that's the real. That's very cute, fucker. Go fuck yourself. In the real world, let me see if I can find the real exchange rate. Black market. And usually you have to rely on estimates from the Bolivar plunges in black market of Venezuela's stashed dollars. See? largest bill of 100 bolivars is now worth less than a U.S. quarter. So it is 423 bolivars to $1 US. So you're losing 99.75%, I think. Did I do that right? Anyway, so that is what happens when you cheat. Is no one, if you have a fixed peg currency and you start printing off more money, or you just don't keep your economic growth up, people stop doing business in your currency because it's not right. Well, not only is it not right, it's not profitable. Fuck right. It's that, but more importantly, it's not profitable. So goods and services dry up, your economy goes to shit. Oh, so what else? So we have talked about central banks manipulating their supply to help economic growth at home. They lower or increase interest rates. You saw that over in Russia, where they increased the interest rate to 6% to get more. So they're even though they're claiming that it is a free floating exchange rate, the central banks are always intervening. We talked about cheating on a fixed or a pegged thing. Then there's speculators. This is another complication. I alluded to it before, but you can even have large speculators really throw off large currencies like the US dollar or the British pound. All right? But if you're some small country, you really got to worry about speculators, and there are raiders that will come in and they'll say, hey, we're going to drive the currency up, and then we're going to short sell it and drive the currency down. We're going to make money. And that's all great and well for Goldman Sachs and Morgan Stanley. But that's not good for people like in a small country, Trinidad, Tobago. I want to say Tobago because it's Toboggan, but it's not. I had a client there. But small country, highly export independent on sugarcane and tourism. I think bananas as well. It takes, you don't even need to be Goldman Sachs. You could be a medium-sized bank and you just short the Trinidadian dollar or whatever the currency is. And now you're putting whatever the population of it, a couple 100,000, I'd imagine, you're fucking with that country's currency. So speculators are. This makes a case for a small country to go and peg it to a dollar and to try and keep their economy up, because I don't know if you noticed this, but based on the housing bubble, bankers are kind of fucking scumbags and they ought to be dragged on the street and shot. But that's illegal. Anyway. So that's another thing that you got to always worry about, especially when it comes to smaller economies. When banks are larger than certain countries, that's something that smaller countries have to worry about. All right, then here's another one. And this is the main genuine economic argument that you might make for manipulating or having a currency pegged or some kind of stability between your currency and other currencies. And that is exporting costs and importing inflation. Perfect example. 2000, I remember. U.S. economy is going down the toilet, and I'm like, I'm going to invest in Swiss francs. So I invested in Swiss francs. And I'm like, cool, I got my position. I invested a couple thousand. And the Swiss currency was going up because they don't have debts. They got their shit together. They're hardworking people in their first world. Terribly sorry. Western civilization kicks ass, and we're the most economically productive. And that reality is represented. So I was making like 50%. I was up like 30 or 40%, maybe even 50. I was just killing it. And then the Swiss central bank comes out and says, we're going to cut interest rates by 1 full percent, and we're going to print off a fuck ton of Swiss francs. I'm like, what? And I didn't even know the press release came out. All of a sudden, my position was down to nothing. I didn't lose it, but I didn't have a gain. I was like, what happened? What the fuck? And you say, well, why would they print off their money? Why would Switzerland do that? Their currency, the franc, was very valuable. They were winning. You got to think about their exporters. A lot of economies are very highly export dependent. Saudi Arabia, Switzerland, a lot of those Caribbean countries, Trinidad, they export their bananas. They're sick of bananas. They don't want to eat any more of their bananas or sugar cane. They want to trade it for something else. So they are highly export dependent. Hong Kong, Japan, perfect. They're exporting cars and electronics. And if their currency gets too strong, that means, okay, in their local economy, it doesn't matter. Internationally, the Hong Kong dollar is the Hong Kong dollar, the Japanese yen is the Japanese yen. But if the yen or the Hong Kong dollar or the Swiss franc become too expensive, guess what also becomes too expensive? Honda cars, Sony televisions, Swiss chocolates and Swiss clocks, which are very watches. In other words, Switzerland is a very large export-based economy, and so if they don't sell their stuff, they don't sell their goods to foreign investors, these companies can go bankrupt, or they can have a very bad year. So the government will come in to protect their industries, and they will ironically weaken the home currency against other currencies to make their exports more competitive. And that's what happened to me. So the central bank came in and went, fuck you, Clary. And I'm like, fuckers! Or whatever you would say in German, or auf Deutsch. And so that happens. Then the other kind of side of that coin is you import inflation. If your currency gets too weak, is the opposite, now, let's say the dollar really collapses against the yen, all right? Now we got to pay a lot more. Let's say the dollar collapses against the yen by 40%. Well, guess what? It probably wouldn't happen, but let's say it does. Cars become a lot more expensive. Those PlayStation 4s, they just became 40% more expensive. So unless they're made here on our shores and the costs are based in US dollars, if they're determined in foreign currencies and our currency goes down against that currency, then it's that much more expensive. We need more dollars to buy that same amount of yen to get ourselves a PlayStation 4, which you should never buy because it's a shitty console system anyway. So that is another reason why central banks will manipulate, even though they might have a free floating exchange rate, even though they have that, is to protect not only their exporters, but also protect their clients. I wish the government would view their citizens as clients. That would be good. But to protect their citizens from importing inflation. Right? Then finally, what you have is where you don't have your own currency and it's attached or pegged to another one. This is where you run into a problem of debt, specifically internet government debt being determined or denominated in a foreign currency. Now, we saw this in Greece. Greece, they decided to join the euro because they're a bunch of welfare parasites and they want to live off of all the other hardworking Europeans. And that's the truth. And you guys can go fuck yourself if you disagree. Actually, and they voted in a communist. So this is what that big Greek bailout thing. Well, one of the major problems of the Greek bailout is that the economic production of Greece is based in Greece. And when you're like eating olives and saying, give me a government job, oh, I'm Greek, oh, I got my curly hair, I want more olives, make sure there's like blue cheese in the olives this time, I want to eat it. What? Pay for it? No, the Germans are stupid, they'll work hard for us, they're always suckers, they still have guilt over a war they didn't start because all the Nazis are dead. Well, we'll pull out the Nazi card anyway. I make international economics so fun, don't I? Anyway, so Greece borrowed a bunch of dollars. Well, they joined the euro, so guess what? They borrowed a bunch of money. But Greece joined the euro, so guess what? The debt was denominated in. They were lent euro. They weren't lent drachma. They got rid of their currency, the drachma, a long time ago, and now they borrowed euro. But their economic production capacity is in Greece, and Greece does not have the work ethic or basically the economy or the government that allows economic production to pay that off. That's where their debt is like 400% to GDP. So what happened is, as it became more and more apparent that Greece was not able to make their payments, in terms of what Greece could actually pay and produce, its economy shrank relative to the... In other words, like, a contract from Greece, that's worth less than you think. So even though there was no drachma anymore, their debt was denominated in euros, which kept going up in value relative to what Greece could produce. You saw this even more so, I think it was Argentina, where they had the Argentine pesos, but their debts were denominated in US dollars. And as their economy tanked, the peso dropped relative to the dollars, which increased the amount of economic production they'd have to do to pay the US or the US dollar-denominated debts. It increased it like 8 or 9-fold. So it made it impossible. So you can, if you have a pegged exchange rate, or you have your debts denominated in dollars because, well, dollars are stable, we don't want none of your fucking Argentine peso funny money, or you Greeks with your fucking drachmas, we want euros or dollars, and if your local currency drops relative to that, well, then your government debt just went up like that. So that's another thing that can happen there. Now, with all that, I gotta contact the Beklov. Hang on, let me pause this real quick, and then I gotta text him. Okay, so getting to your question. Now that you have that, you kind of have an idea of... It really is just supply and demand of money, with interlopers being speculators, governments, central banks, and stuff like that. But all currency must derive its value from economic production of its home country. So if you can understand that, you can kind of understand what your questions are here. So let's go through your questions again. The benefits and disadvantages of a country pegging its local currency to the dollar euro. Benefits, stability, protection from speculators, and if you play your cards right and you don't fuck around, you can actually get your economy going and boosting. You can kind of piggyback. It's like having a big, large, boat pulling your small little boat around. You get up to speed, fire up your engine. There you go. You're off to the races. You can get your own currency. Disadvantages: you are tethered to that ship. If it sinks, or you have an international currency crisis like we did in 2007, you can get wiped out. All right. So it really does depend on what your goals of your country is. And if your country's large enough, you don't have to peg it. And then as well as how do countries strengthen or weaken their currency? Well, they do it through their central banking system. They either increase the money supply, which would lower the value of the currency, or they lower the interest rate, which means the government, federal funds rate, central banking rate, which means, well, we get less money when we invest overseas over there. So if you like Switzerland did with me, how they fucked me, they lowered their interest rate by a full point. The currency went down in value because people demanded less Swiss francs. And Russia was different, I think, in 2012, where, wasn't it? No, I think it was 2014. Oil prices dropped. Russia needed dollars, so they increased the interest rate on the Russian government bonds, and people flooded the market. They bought rubles because that's government. You need the rubles to buy the Russian bonds. So that's how you increase the value of the currency, and then you can also weaken. Well, that's weakening. You can weaken your currency by flooding the market. You can strengthen your currency by buying dollars out of the market. They do that through federal open market operations. I won't bore you, but you basically swap out government bonds and you take money out of the economy and leave it in the vaults of the Federal Reserve. So it's not circulating anymore. It's just in there at the Federal Reserve. Then, briefly say something about U.S. policy towards manipulating the dollar. Russia and the United Arab Emirates have central banks, but I don't know if America officially has one. It certainly does. It's called the Federal Reserve, and we manipulate the fuck out of the dollar. We've manipulated it more than any other currency, I think, bar maybe Venezuela, because we are basically printing off as much money as we can because no one will lend our government money. And what the Federal Reserve does is it prints off all this money and it buys U.S. government bonds from the federal government. This gives the government money. The Federal Reserve takes the bonds, which will probably never get paid back on. The Federal Reserve is not the U.S. government. It's different. That's a separate thing. And then that allows the government to basically blow all the money on everything it wants. Everything from military to welfare pieces of shit that vote in Obama all the time. Greece is pretty much the exact same thing, except they don't have a central bank. They belong to the European Union. So they don't have the right to print off their own money because they don't have the European Central Bank. But they get loans from all the other hardworking Europeans, and then they piss it away on their parasites. Oh, it's just socialism, yeah. So that's it. Anyway, I hope that helped. I hope we all learned something about international economics and currency. And if you have any questions, go to assholeconsulting.com. We will do serious topics like this, but it will be cursing and swearing and me not showering. Best of luck to you. Toodles.